Hello, tradeologists. Hey, I want to welcome you to this really special video that I'm doing. I think you're going to be super excited about this because it's a way that you can just kind of set and forget your trades. It's really interesting. Although there's a little tweaking to go, around as things progress in the trade, but still, these are the kind of trades that you can kind of put on and forget about until something triggers. So I think you're really going to be excited about this because what it does, and the main objective of this kind of trade, is to totally limit your risk. I mean, really limit your risk. I'm not talking about limiting your risk to maybe losing a few $100s. I'm talking about limiting your risk to maybe 10 or 20 bucks, 40 or 50 at the most, and then having totally clear upside potential. Could be into the thousands of dollars. There's absolutely no limit to the upside potential of these kinds of trades. And when you start to put together a portfolio of these kind of trades, you're going to see a real dynamic and interesting effect on your portfolio. So that's what we're going to take a look at today. This is a trade that doesn't seem particularly intuitive. It's not something that you just kind of think about and say, oh yeah, this sounds like a good trade. But it does help mitigate your risk. The downside risk is almost minimal. In fact, you could even make money on the downside in some cases. If you scour through enough stocks, you can actually put these on so that you make money whether the stock goes up or down. Even if you have, our primary goal is to have an unlimited upside potential on these kinds of trades, which means that you can make anywhere from 20 to 100 to 300 to 500 to 1,000, 4,000, $10,000. The upside limit is absolutely, it's unlimited. So, and on the downside, if you happen to get it wrong, the risk is minimal. In fact, you could even make money if it goes down. This is it's a very simple trade to put on. It's very quick to get filled on these. You don't have to play around with mid prices. Generally, you're just putting in market orders, limit orders, basically. But I'm going to show you exactly how I'm going to do it because I'm actually going to put a trade on, live, recorded live, right now. This works best with stocks that are in the news all the time. Now, I've been looking at Yahoo, and we'll talk a little bit about Yahoo, but if you watch CNBC or you watch some of the other financial news channels, one or two stocks generally are highlighted in a particular day for some kind of news, like a takeover or maybe a buyout or maybe something. There's something in the news about these particular stocks. And you know what? A lot of times, the stock won't move right away. You'll feel like the news is starting to build up. Maybe you start to hear about it every single day, or maybe a couple times a week for a couple of weeks, and you feel like, boy, I wish there was a way to play that kind of stock and really have the unlimited upside potential of the stock, but not get hurt if it goes the wrong way or if the deal doesn't go through. So this is a way to play these. I wouldn't suggest using this necessarily on just any stock that you want, although, if you see, I'm building a portfolio of these kind of trades. The risk is really quite minimal on them. But there are a couple of risks specifically to this type of trade that we're going to talk about as we go along here. Okay. So as I mentioned, I'm looking at Yahoo stock. Now, there's lots of trades that you can make, obviously, right? I mean, you could go ahead, if you think that the stock is going to be a takeover target, you think somebody's going to buy Yahoo, as is what happened basically at the beginning of February of this year, you can see that Yahoo is trading down here at around the $19 level. I'll just put a little oval around this. It's trading down here around $19, and news came out that Microsoft was interested in buying Yahoo. Well, what happened to the stock? It went from $19 up to $28, $28.50 the very next day. So we had this huge move up, But you know what? In the news, there was actually quite a bit of information about, potential takeover targets, Yahoo's potential takeover target for, they weren't quite sure. They didn't have a vision. They didn't have a business model. They had revenue. They had cash, but the owners, the CEO of Yahoo wasn't taking it in the right direction. There was no clear vision for the company. So, I mean, there was rumors of a potential takeover of Yahoo, so you could have played that alone and just kind of got into some position. But what do? I mean, when you get a news story like that or a rumor or something like that, sometimes they pan out, sometimes they don't pan out. In this case, Yahoo was trading about $19, and then the very next day, when Microsoft came out with the news that they're interested in purchasing Yahoo, it jumped up to $28. It traded as high as a little bit over 30 here, and then as negotiations continued, and then finally there was quite a bit of disappointment when Microsoft started backing out of the deal and saying that maybe they're not that interested in Yahoo after all. The market, the stock just basically tanked. So now we're back down to around 21.50. Now today, in the news, there was a big, this is July 2nd of 2008, the Wall Street Journal, headline news, Yahoo could be taken over by maybe a number of different players. So there's more takeover news related information about Yahoo, and you feel like, something could happen here. What if they get a bid out, if they get a takeout offer of, around 32, 33, which is probably, or 34, which is close to the high of October of last year. That's a $14 move, $13 move. How can I play that? And this type of a trade that I'm going to show you really helps to answer that question for you. The goal, of course, is to limit your risk, because if the trade doesn't work out and the stock, a lot of times investors, when they're disappointed in the fact that, hey, nothing's going to work out, nobody's going to actually take over Yahoo, they're going to sell the stock off, and the stock's going to be in the dump. So you have to kind of think about, well, how do I have unlimited upside potential, but at the same time limit my downside risk? And that's the key. So let's take a look at what a traditional strategy might be. Number one is obviously to buy the stock. Well, if you buy the stock right now at $21.53, you have unlimited upside potential, to be sure. But you also have, some downside risk here. I mean, it's not unlimited downside risk because obviously Yahoo can't go below zero, but it could go to zero and you'd lose your entire investment. So there's ways in which you can, in fact, limit your risk. But let's take a look at this just for a second. Let's go into let's take a look at Yahoo here, and let's go ahead and open up. We're going to click on the asking price here. I'm in my Thinkorswim trading platform. I got my limit set up to $500 per shares of any stock that I purchase. You can set it, of course. You can buy 100 shares, you can buy 50 shares, you can buy 5,000 shares. It doesn't matter. All right, let's go ahead and analyze exactly what your risk is here. We're going to go over our Analyze tab here. I only want 500 shares. 500 shares of Yahoo stock right now at $21.46, which is the current $21.47, gives you unlimited upside potential. So if the stock does go up, to $30, which a lot of people are saying is probably the takeout price, if somebody did come in and offer shares, for Yahoo, make a good offer on Yahoo stock, your upside potential is about $4,200 for 500 shares. Let's say we don't want to go that high. We only want to buy 100 shares. Okay, well, 30 will give you about $900 in profit if it gets taken over at $30 a share. The problem, of course, is that if stock goes down, you could easily lose $900,000. In fact, your entire investment if it goes down to zero, or $1,795. So, there's obviously you have unlimited upside potential. The problem is you've got also nearly unlimited downside risk of your entire investment. Let's go back to a trade tab here for a second. An alternative instead of paying $21.47 for 500 shares, you could go in and purchase options on Yahoo stock. If you purchase options on Yahoo stock, they do expire at a certain date in the future. So you'd have to select the date in which you'd like to buy your options. You have the July, you have August, you have October, you have January of 09, and you have January of 10. Those are the ones that are available right now. The problem is your timing. You can't really determine when, if, in fact, Yahoo stock is going to be bought out. So let's say you're relatively optimistic and you go for the August options. Well, the August options right now at the $20 level are selling for $2.87. The $22.50 level, the calls are selling for $1.65, and at the $25 level, it's 89 cents. So you figure, hey, look, if it goes to 30, I buy the 25s for 89 cents. A couple of these, if I was going to buy 500 shares of stock, well, I can buy 5 of these calls and basically limit my risk, and also have some good upside potential, because if it goes up to 30, well, these 25 calls in August are going to be worth $5. So because they're $5 in the money. Now the only problem is, of course, you have to be right as far as your timing. August has to be, the deal has to come in August before the third week of August, in order for these $25 strike calls to be worth anything at all. If this goes to $26, well, you're just about breaking even. If the buyout price is $26, you're going to make those 25 August calls are going to be worth $1. So that's going to be, just about your break-even point right there after commissions, right? If you buy the $27.50 call, those are only 48 cents. But the problem is, if the takeout price is $30, you've only got $2.50. That's still not bad, because you're really basically, you're going 5 times the price, or 4 times the price of what you're buying here, or maybe even 5 times the price. So, that's a good size profit. But let's take a look at the 25s, because you want to get that full $5 of, profit potential in there. But let's take a look at it and analyze it just like we did with the stock, and you can tell that you do have unlimited upside potential here. If the stock moves up to 30, you could make $2,400 on five contracts of the August 25 calls. But you also could lose your entire investment if the stock doesn't move. In fact, if the stock doesn't move within like 2 or 3 points here, you're going to lose your entire investment, which is okay. I agree, it's not much. It's only $445, but still, you don't want to do this 2 or 3 times a month. You don't want to do an investment, just buy outright calls, especially out of the money calls on these kind of stocks. And if nothing happens, you end up losing about $500. So in order for this to break even, you can see the break even price here is just a little bit above $25. In order for this to work out, you've got to be above $25 to make any money, and about $25.25. So anything below or anything above that, up to $25.25, you're going to lose almost the entire investment of $445. It's not a bad play, but I think we can do better. Let's go back and take a look at our trade tab for a second. Now, the other thing that you could possibly do is create a vertical spread. In other words, you want to buy a lower price strike price call, and you want to sell a higher strike call. And this creates a spread which limits your risk to the downside, because if you are wrong, the call that you sold will reduce in price, generating a small profit, helping you to reduce the risk on the long call that you purchased. So let's say you're really bullish, you really think this deal is going to work out. So you go for the 22.50 call and you sell the 30. You sell the one that you think is going to reach where the price is going to be if somebody does make a takeout offer. So if, let's say they offer $30 a share for Yahoo, that's the one you want to sell, if that's what your analysis is telling you. If you think it's going to be 35, Well, you could go up to 35, but the problem is that these are so low priced that selling these calls up here doesn't really give you much protection on the downside, does it? So I don't recommend that. But this is a potential strategy. You go to buy a vertical spread, and the spread we want to sell is the 2250-30. We want to sell those 30 strike price calls there, and that's going to cost us $1.43 at the mid price. We'll probably get filled at around $1.45 for that, but it has the potential of moving up $7.50 if we do hit our price target. Now we want to do this 5 times, and we're going to go ahead and analyze this as a duplicate trade. Let's see what happens. Well, right now with the price just about right in here at 2151, which is right here on my graph here, what you can see is that, you know what, if it's you still have to move up in price in order for this thing to work. Yeah, which is expected, you know, and you really do think that it's going to hit 30. So now if you hit 30, you know, your potential payoff is around $3,000. That's a pretty good payoff, no doubt about it. I mean, if it works out and somebody does offer $30 a share for Yahoo, you're going to make about $3,000 because you'll be right in here. The problem is, of course, is if nothing works out at all, or just, you know, the stock goes up a little bit, you're going to lose potentially the maximum amount of money. In this case, it's $725. So if the deal does not work out, the stock trades down to $15, or even if it just stays the same, if it goes from like anywhere from, looks like $22 or $23 here. Let me just spread this out a little bit. Looks like around $23.66. If it doesn't trade that high, if it stays below that, you will have lost almost the entire investment of $725. Now that's even worse than buying out the outright call. The outright call only costs you $445. So vertical spreads can be good in these situations. However, you're still risking a maximum loss of $725, which is the cost of your spread. So is there an alternative? I mean, we looked at buying the stock, we looked at vertical bull call spreads, and now we've looked at, and we've also looked at just outright buying a call to take advantage of any upside potential. The problem, of course, is that you have a large downside risk. If the deal doesn't work out, let's go back to our chart here for a second. If the deal does not work out and it trades down to 1850 or below, well, you're going to lose all of your investment. Either in you're going to lose a lot of investment in your stock. You're going to lose most of the investment in your call. If you're lucky, you get out before the bad news hits, and you save a little bit of your call premium. Or you put on a vertical spread, a bull call vertical spread, like I mentioned, and you know that's going to cost you $725, and there's no guarantee that it's going to move up enough in order for you to get into any kind of a profit situation at all. None of these scenarios are really interesting for me. What I like to do is kind of introduce you to the concept, and I'm going to show you a portfolio of trades. Now, this trade in particular was shown to me by a 30-year veteran in the markets. In particular, one gentleman who had run a brokerage firm in New York City for many years had retired, and this is a strategy that he developed. And actually, he was going to retire, but he ended up not retiring, and instead, he started a small hedge fund that does only these kinds of trades. So this is really inside information that you're not going to find anywhere else. It's very similar to another kind of trade that's talked about a little bit in several different books, but it has a couple of different twists to it that I think you're going to really find interesting. If you know options at all, you know what a back ratio spread is. Well, this is very similar to a back ratio spread, only it's much more favorable to the person putting on with very limited downside risk, maybe even a profit on the downside, and unlimited upside risk, which you don't really get with a back ratio spread very often. So let's go back to our trade tab here just for a second. We've gone through a couple different scenarios. What I want to do now is just set this trade up for you, and then talk about the entrance and other kinds of criteria. Basically what you do is you start with the front month option. In this case we're in July. But I want to make it clear too that this is an option strategy. Now it could turn into a stock strategy, but right now it starts out as an option strategy. So you have to be comfortable with options to begin with. But if you're watching this video, I'm guessing that you probably are already somewhat familiar with options, and if you're not, there's plenty of good resources out there to help you get familiar with what options are. Basically, options are simply financial instruments that you can buy and sell around a particular issue of stock that helps you basically manage risk. Some people use them for speculation purposes. You know, if they think a stock is going to go up a lot, they'll buy a cheap call. They'll buy some puts if they think it's going down. But they're basically hedging and risk management financial tools. What we'd like to do, and it's very, very simple to get this thing started, but I'm in my Thinkorswim platform, and what I do is I set up my advanced order way down here, down at the bottom here, to first triggers sequence. And what I want to do is I want to be able to go out into a far month, generally a time period in which I think, in fact, news is going to break on the stock, this particular stock that I'm targeting. So in the case of Yahoo, if you take a look at the time period between February and July, February was the month in which, you know, the news came out, and now we're in July, and some more news has come out about that. What's that? February, March, April, May, June. You know, about 5 months, because we're still in the beginning of July here. So if I can go out another 5 months, that will probably give me the time that I need in order to determine whether or not this is going to be a viable strategy. And in fact, Yahoo will in fact get an offer for their stock. So if I go out July, August, September, October, you know, November would be ideal, but we don't have a November. We've got October, and then we've got January. I'm not so sure I'd like to go out as far as January. So I'm going to start with October. And what I want to do is a basic strategy of buying some calls that straddle the current prices, just a little bit above the current price. The current price is $21.89. So I'm going to go ahead. Let's say I want to buy the $25 calls, which is just a little bit above. I could have gone with the 22.50s, but I'm a cheapskate, so I wanted to buy a little bit less expensive calls. So I'm going to go out to the 25s, which is just about $4 above the current price. I think and I believe that, you know, $30 or higher is probably going to be the offer that is going to be made on Yahoo if somebody makes an offer. I'm not saying, in fact, this is not a recommendation to buy Yahoo stock or to do anything with Yahoo whatsoever. This is only for illustration purposes, because there's lots of stocks out there that are in the news. Lots of talk, lots of rumors, and this is the kind of thing that you can put on any of those kind of stocks if you can find the favorable conditions. This is what we're going to talk about right now. So I've got the October 25 call here, and because it is a back ratio spread, technically you could say it's a back ratio spread. I tweak it a little bit, and you'll see how I do that in just a few minutes. But I like to buy a longer dated option, October. In this case, we're going to go a little bit above the current price of the stock, right around 25, and we're going to start out with at least 3 of these right now. Then what I like to do is go back and do something that's counterintuitive, and that's to sell an in-the-money call. And I know what you're thinking. You're probably thinking, wow, you're selling an in-the-money call. If you know anything about options at all, it means that when somebody sells you, when you buy a call, you have the right but not the obligation to purchase the stock at the strike price that you have purchased. In other words, if you buy a call at the July 1750 strike price, that means it gives you the right in the future to purchase shares of Yahoo stock at $17.50. You're not obligated to do that, but you can do that. It gives you the right to do that. But what we're doing is we're not buying them. We're actually going to be selling one of these. So we're going to set that up. We're going to actually sell one of the 1750 July in the money calls. Now, this is part of the risk of this trade, although it's fairly minimal. We are going to be putting on both of these trades at the exact same time. The 3 October Yahoo calls at $25, and we're going to sell one of the Yahoo July 8 1750 calls. And we're putting them on at the exact same time. For those of you who know options, you understand that if you sell an in-the-money call, the potential is there to have the stock assigned to you. And what that means is that if you sell one of these contracts, the person who bought the call, okay, the person that you sold it to, or maybe somebody else, anybody who's long that call can exercise their option, and randomly you could be picked to have that stock sold to you. So you would automatically have a short position in the stock at $17.50. However, you're going to have these 3 calls in the October 25 strike price as protection against the short stock that you might be assigned. However, that doesn't happen too often, but it is a risk. But it's not a risk in a bad way, because as you'll see when we go ahead and do our analysis of this trade, the risk is really extremely minimal. So let's go ahead and go back to our analysis tab. I'm going to go ahead and analyze this first, just the 3 October 25 calls that we're purchasing. And look what happens. We have a very similar risk-reward, profit and loss graph that we did when we purchased an outright call on the stock itself. In other words, we have a maximum loss here of $411, which you can see is the green line, which is our expiration line for this particular option, which is in October, expires in October. And we also have the white line. Our white line is our current profit and loss graph. So if we were to purchase the October 25 call right now for $1.37, if the stock moves up, we follow this white line, and we would actually profit from that. If it moves down, we are going to obviously meet our maximum loss, which is $411 on this trade. Like I said, not a bad scenario, but you know what? If you do these more than 2 or 3 times a month, I don't want to lose $400 on each trade that I do. So let's go back to our trade tab for a second. Now we're going to bring over the one call that we sold at the 1750 strike in the near month, which is July. All of a sudden, our graph looks extremely different. It looks much different than it did just a second ago. Let me take that out for a second to show you the difference. That's with selling one of the July 1750 calls, and that's without selling the July 1750 call. That's maximum loss of $411. Yes, we have unlimited upside potential. But now look what happens when we sell that one in the money July 1750 call. All of a sudden, we have a scenario in which our maximum loss, if we take a look right here in the center, which is the low point of our expiration, green line, our green line is our expiration of $50. That's it. That's our maximum downside risk if nothing happens in this stock. In fact, if the stock trades down a little bit, let's say the deal doesn't go through and the stock gets sold off as a result, we can actually make 60, 70 bucks if the stock trades down. What happens if it just falls apart completely and goes all the way to $5? Well, at the most, we can lose only $11. That's it. That's our maximum loss. Unless we stay right around this level here and absolutely nothing happens, we lose about 50 bucks. However, the important thing to consider is the fact that we have unlimited upside potential on this particular trade. This is what separates this kind of trade from any other trade that I've ever seen. And what it does is that, yes, I mean, you're not going to get the total profit potential. You know, if you had just those calls out there, you're going to make maybe $1,000 at expiration on these. But when you sell these at $30, you're only going to make $624. The difference is that you can just set and forget these kind of trades normally. You're going to have, very little downside risk. You have, if it goes on, if the Yahoo stock gets cut in half because the deal doesn't go through, you're going to lose $10. That's the maximum risk on this trade. Remember, if we had just the outright calls here, if it goes down to $10, we're going to lose $411 on those. Also, if the stock stays right in the middle, right where it is right now, we lose a maximum of $49.63, as you can see over here on the expiration graph. So our downside risk, if nothing happens, we lose $49. If you just bought the call outright and nothing happens, we're going to lose $411. What happens if the deal does go through? Well, if the deal does go through, all of a sudden the stock shoots up to $35. At $35, we're making $1,400 in profit. We have unlimited upside potential. As you can see, we can go out. I mean, let's say somebody's crazy enough to offer Yahoo $70. We're up about $9,000 at that time. So we actually have unlimited upside potential on this. It does not stop. It continues to go up and 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 up. However, the real benefit of this kind of trade is the very limited downside risk. In fact, we can make a little bit of money if it ends up in this area right here between $15.50 and about $18 or $19. So if we trade down a little bit, we make money. If it goes up forever, we make money. If it goes down to nothing, we lose $11. Now I'm going to show you just in a second some of the other trades that I have on here, and I think you're going to find it extremely interesting when you begin to put together a portfolio of these kind of trades, how dynamic this kind of trading can really be. So here's the trade. We're buying 3 of the October 25 calls. We're selling 1 of the in-the-money July 1750 calls. And let's go back to our trade tab here just for a second. I'm going to show you how this is actually entered in my Thinkorswim platform. What I want to do is I don't want to sell a naked call. So that is my second trade. My first trade is to purchase 3 of my October 25 calls here. I just want to make sure I got the right ones. And then, so under the advanced order tab, instead of blasting all or single order, I want to do first trigger sequence. In other words, when this one gets filled, then this one gets filled. So that's what I'm going to do right now. I don't have to fool around with midpoint prices. All of the stocks that I do this on are actively traded stocks. These are all actively traded stocks. So I'm not too concerned about mid prices on these. I mean, I'm talking about 5 cents in between, the bid and the ask, which is pretty normal for almost any kind of stock that you're going to be trading on an individual basis. This is not a spread order. This is not entered as a spread order. You are entering individual option orders. The deal is that you want to get these 3 long October 25 calls entered into the market first, and then you want to sell one of the July 1750s. You don't want to do it the other way around. You don't want to sell that Yahoo call and then buy your 3 October 25 calls. You want that. You want those first. You want the July, the one that you're selling, second, to be placed second. So in this platform, all I have to do is hit confirm and send. The total cost of this trade is going to cost me $411, which technically is actually the risk that you have on your long calls. Because it's not technically a spread, they don't margin it that way. They margin it based on the risk that you have in your long call. So that's just something that they do. So I'm just going to go ahead and send this in. You can see we'll probably get filled instantly. Yep, we got filled instantly because we were both at the we were exactly at the asking price on both of those. Now I have those. Now let's go over to our Analyze tab again. We'll take out the simulated trades. This green and this red line are the ones that we simulated. And you can see that we have our trade in. Our maximum risk is $44, which is at expiration of the July option. And our maximum downside risk actually improved a little bit. The most we can lose if the stock goes down to $10 is $5.83. That's it. In fact, we got a little profit already. We're up $3.86. But we have not limited the upside potential of this trade. I mean, this trade can go up forever and ever and ever, and as long as we do it before October, which is kind of the target date, I figure that if anything is going to happen with Yahoo, it's going to happen by October. So if not, we can always put this trade on again. Now, if this Yahoo stock trades down a little bit, I could actually make some money right around 17.50. I'll make about 60, 70 bucks. Not a lot of money, but you know what? When you have absolutely very little downside risk, you have unlimited upside potential. You can afford to put these kind of trades on and let them go and just kind of see what happens. So let me show you. In fact, let me go. I have it right now under my positions and simulated trades. I have a single symbol, which is just Yahoo here. What I want to do is show you some of my other trades so you can understand how I built a portfolio here of trades. Let's take a look at them and see how little risk I actually have. I have a trade just like this on the Qs that you can see. I have a position on Verizon using the same method. This is Washington Mutual Bank, the XLF ETF, and now Yahoo. So these are my trades, and this is my portfolio. Let's take a look at the expiration risk here. It's minimal. It really is minimal. I mean, if things trade down here, my total risk on all of these trades is about 94 bucks, maybe 100 bucks at the most. But I have, because of the way I've put these trades together, I have actually unlimited downside profit potential, and I have unlimited upside profit potential, and very little risk right in the middle. So I'm able to profit whether the stocks that I picked go down or go up. Let me just show you an example, because I told you that you can actually find these trades. You can actually find these trades in which you make a profit if the stock goes down. Well, in this case, Verizon had a very interesting. I set it up very, very well. And it gave me some very favorable pricing, so I had unlimited upside potential on this trade, as you can see. But also, my maximum risk is about 68 bucks. But I also make a nice profit if the stock just gets tanked and people are selling it like crazy. It doesn't matter where it goes. I'm going to make anywhere from 130 at the peak here, 158. 134, 127, 125, all the way down. Even if the stock trades down to $25 and gaps open to the downside, I'm going to make 125 bucks. All the way down to zero. I mean, if it goes down to zero, I make $125. So sometimes you can find these trades in which you, in fact, can make money whether the stock goes up or down, even though you're playing it to go up. Same thing with the Qs. I actually put this trade on in which, hey, the Qs get tanked. I still make 15 bucks. It's not a lot of money, but I still have that unlimited upside potential on these kind of trades. Who else did I have? I had Washington Mutual. Washington Mutual was a very, very favorable one. I couldn't resist this one, because if the stock doesn't move at $5.48, I make 25 bucks. I still have unlimited upside potential on Washington Mutual, and my downside risk is 22 bucks. That's it. And I've got unlimited upside potential. So if Washington Mutual all of a sudden has a great, some great report where, they're all of a sudden making money instead of losing money, and they don't have to write down a bunch of stuff, well, I've got an unlimited upside potential on this trade. And even if it trades down to like $4, I still make money. So, sometimes you can find really favorably priced trades here, and the thing is that you have to kind of keep your eyes open for. Let me take a look at my XLF trade for you, which is the final one I could show you. You have to keep your eye open. This one I traded to the downside, but I left my upside potential intact, so you can see that. Even if the XLF does in fact take off here, I can make $108, $109, $106. It doesn't matter how high it goes up. I still make money. I still make money with the trade. My maximum risk on the downside on this one is about $100, but I've got unlimited downside potential too, because if the financials really get killed again and it does go down to 10 bucks, I'm going to make $1,000 on this trade. That's the only one that I've traded puts on, because you can do the exact same thing with the puts that you did with the calls. You can sell an in-the-money put, and you can buy out-of-the-money puts in a distant month. Same thing, same way that you did the calls, you could do it with puts as well. If you're bearish on stocks, you could do the exact same thing here, and just trade these so that it's very favorable. If you're wrong and they go up, you can make money, and if they go down, you can make unlimited money. So there's lots of ways that you can play this. Now let me put that back together in a portfolio view for you, and you can see, I have, if the market goes down, I make money. If the market goes up, I make money. If it stays the same, I lose a little bit of money. But I've got so many different trades going on at this one time that if I lose 50 or 60 bucks on one, but I make $300 or $400 on another, that's not too bad. If we take a look at the price slices here, you can see that I'm actually making money today, about 60 bucks. If I go up, I make a lot of money. If it goes down, I make money. But it doesn't matter. Either way, I make money. Now, let me talk about the risk before we leave here, and we close this out for the day. Now, the risk is that I've sold this Yahoo 1750 call. If I get assigned on that, what I'll do is I'll take those 100 shares that they're going to assign me. I will have to buy, or I will be short 100 shares of Yahoo stock because I sold that call. But I have those 3 October calls to protect me from any upside potential. In fact, I have unlimited upside potential on this trade. What I will do is I will go ahead and buy those back into the market, and then go ahead and roll that trade up into the August 1750, or maybe even the $20 calls. I will sell another call into August and keep my October calls. So that's my exit plan. My exit plan is, let's say nothing happens between now and the 16 days left in the July option. Well, if nothing happens as we get closer to this July expiration, if I don't really want to be assigned on those on that short call that I have, I'll simply roll it up into the August 1750s. And it's going to cost me another 30 cents, but you know what? That's not a big deal. I've eliminated some of my risk. Maybe I'll actually make a little bit of money on that and roll it up maybe for even money to the August 1750. I still have my Octobers out here, waiting to be profitable if, somebody makes an offer for Yahoo at $30 or higher. But I still have my unlimited, I still have my limited downside risk because I've shorted that one in the money call against the 3 that I bought out in October. So that's the plan. That's the exit plan. The plan is to hold these out. I will sell the near term in the money call if I'm looking for an upside pop on a stock. If it doesn't happen within the next week, I would say 7 to 10 days before expiration, when that gets down to a number 7, when there's 7 days left in the July expiration, I'll want to roll those up to the August 1750s and sell those. Sell one of those, hold in there until probably the 3rd week in August. Now, if nothing happens by the 3rd week of August, potentially I could roll it up again into the October 1750 calls if I still think there's some potential in this trade. If not, I'll just close the whole thing out, probably for even money, or maybe I'll even make a little bit of money. But you know what? It's such a low risk trade that it doesn't matter. I mean, you can just kind of let these things go, kind of keep an eye on them. Just make sure that, just a few days before expiration that you roll them up to the next month. And I would do that a couple of times. I would roll it up maybe once to August. Maybe, since they don't have the Septembers up, you could roll it up from the August to the September when they put the Septembers up there too. So you could roll this out actually a few months, maybe even make a little bit of money on the income that you're generating by selling these calls in July and August and September. So that's the plan. I think is a dynamic way to trade, especially when you put together a portfolio of these different kinds of trades. It doesn't cost you a lot of money. There's very little limited downside. There's very limited downside risk. There's very little risk if the stock just stays the same. And my maximum risk on all these trades is about $100. And you know what? Still have unlimited upside potential on these. So if I get a couple to pop up really nicely, make a few $1,000, and that's not a bad payday. And like I said, I'm only trading 1 to 3 contracts here. Hey, if you got a lot of capital and you got a big budget, these are the kind of trades that can actually, if they pop on you, you can make a ton of money. So hey, I wish you guys all the best. If you have any questions at all on this trade, feel free to review this video as many times as you want. Go through all the details that I just established for you, especially the entrance criteria, kind of setting it up to determine, what kind of profit and loss scenario you're looking at, and also how to exit these trades. Now, you want to put a time, like I said, you want to put a time limit on these trades. If you're getting close to the July expiration, get out, roll it up to August. If you want to give it a little more time. If you want to give it a little more time after August, roll it up to September. I wouldn't recommend rolling it, more than 2 or 3 months. At that point, probably the trade is diminished. The event's not going to happen. Yahoo's not going to get bought out. Just exit the trade at what little tiny loss, maybe $10 or $20, or maybe even you're making a little bit of money, like $30 or $40 in the trade, but you haven't really lost anything, but you got a position in case the stock does pop up. Finally, before I leave you today, I want to go through what I would do. I already had this one planned out. I had Yahoo planned out already. Let's go in. Let's say you don't have any idea what kind of stock that you really want to do this on. You want to be able to do this strategy, but you have absolutely no idea what stock people are talking about or anything else. Well, what you can do in the Thinkorswim platform, at least, and you can probably do this online too, is go to this is very good as well for earnings. Okay, think about it. These are stocks in the news, right? So anytime you feel like, hey, you've been hearing about a stock over and over and over again, and all of a sudden it looks like they're going to be coming out with some earnings. Well, this is a very good strategy to use for an earnings play. If you just take a look through here, you can see that eBay is actually going to come out with earnings on July 16th after the market closes. So let's okay, we know eBay. eBay's a big stock. Has a lot of there's a lot of it trades a lot of shares. It's very liquid. It's got options on it. So let's go ahead and take a look at some eBay options and see if we can find something favorable. Now, we can't always find something favorable. Many times you take a look at some of the options, and even though most of the time you can find something fairly favorable to do this kind of trade with, you can't always find them. So let's take a look here. Let's go to the July, October. Let's keep an eye on the volatilities. The volatility is 51% here in July, which is good because that's the one we're selling. If it's a little bit higher volatility, well, you're going to get a little better price for those calls that you're selling in July, right? So that's favorable in one way already. The October calls are down around 42% volatility. The January 09s are down to 40%. But I think October is probably long dated enough. We could probably even, because it's an earnings announcement, we might even be able to go to the August. So let's take a look at a couple of different scenarios. I would start by taking a look at the August, and I would go out to the $30, which is just a little bit higher than the current price of the stock. Let's go ahead. Whoops, I don't want to sell those. I want to buy those. I always start out with 3, and then let's go with, let me make sure we got our first trigger sequence on our advanced order tag here. And then we're going to sell one of the calls in the front month, which is July. Now, let's take a look at the option expiration here, because we don't want to be, yeah, okay, well, if we take a look at our calendar here, eBay comes out with their earnings on the 16th of July, 2 days before the expiration on the 18th, which is absolutely perfect for our trade. So let's go ahead, and we want to trade. Now what we want to do is we want to sandwich our short call here just a little bit below in the money. So let's go ahead and sell the 25s. And then we'll go over here to our Analyze tab. We're going to analyze this as a duplicate trade. And we have to do these individually because it is not a trade that the Thinkorswim platform automatically recognizes here. Now, here's the scenario. This is what we've got, just bringing up this tab. The stock is currently at about $27.39. We are selling one of the July 25 calls, and we're buying 3 of the August 30 calls. So, in other words, we're playing this bullishly. We're playing this as a bullish opportunity. So if the stock pops up, we have unlimited upside potential on the stock. If the earnings are bad and the stock tanks, well, guess what? We have found a scenario in which we can make a little bit of money on the downside if the earnings do stink. And in fact, if it comes down to around 23 or so, we make about 85 bucks. It's not too bad. We still have unlimited upside potential, and we have a little bit of, just compensation for our time, I guess, to put this trade on, 85 bucks. If the stock doesn't move at all, we risk a maximum of $63 on the trade. Now we can play with these numbers a little bit and see if we can get something a little more favorable. We can actually go out to October and see if that doesn't help our trades a little bit. Now on October, if we go out to October for our long 30 calls, our maximum risk now is only about 30 bucks. The problem is if the stock goes down, we could lose 100, 118, 120, 125. If it goes all the way down to 20 bucks, we lose $140. So it doesn't have as much downside protection. We still have our unlimited upside protection, however, or our unlimited upside profit. So we could go October. Let's keep it October. Let's keep it August for now. Let's play around with the July 25 call a little bit. If we go a little bit lower, maybe we sell the 2250 call. Well, the 2250 call, if the stock doesn't move at all, we have a maximum risk of about 85 bucks, but we do have a lot more downside potential. We have $307 if the stock goes down fairly dramatically here. We still have our upside limit, unlimited upside on this as well. So, I mean, it really depends on what you think you want to do here. If you want more upside potential, if you think the earnings are going to be really good, you could bring your calls in a little bit. So now you start the profit right away. And, you got a little bit more downside risk here, but if it really tanks, you're going to make 30, 35 bucks. But if it just goes down a little bit, down to, $26, you're going to lose $142. We can go back up to the 25s. We can go to the 30s. Now, that's not a bad scenario. With the 30-25s, let's see, the stock is currently at 27. We buy 3 of the 30 calls for August. Maximum risk is about 62 bucks. If the stock drops 7-8 bucks, we make 80. And if it goes up like we expect, we have unlimited upside potential. So this is a potentially good trade, the 25-30. I like the 25-30. Let's add another call in there. Let's see if we can get a little better risk-reward scenario if we add an extra August call. Instead of 3-to-1, we're going 4-to-1. Now, at 4-to-1, we've got $70 of downside risk here if the stock doesn't move on the earnings at all. But remember, they're coming out in the third week of July, so we're short those July 25 calls, and you know what? If if the market doesn't move, if the stock doesn't move, well, we're out of the trade anyway, right? And we'll probably lose not the maximum, but we'll lose probably 50, 60 bucks on the trade. If it tanks and it goes down, we still have a little downside protection here. We've got about $20, $30 that we can actually make on the downside, but we have a lot more upside potential. So this is the one I think I'm going to go for here. This is buying 4 of the August 30 calls, and we're going to sell 1 of the July 25 calls. I like that scenario very, very much. I think for the earnings announcement coming out in July, I think that's a great play. We may get assigned those 25. We may get assigned the eBay 25s. Now, this is one more thing that we can do. Instead of going August on this, we could go October, and we could go August on the one that we sold. But you can see that the scenario is not quite as favorable, is it? Let's go down to 3 of these, and it's still not quite as favorable as using the Julys. So let's go back to the Julys. We're going to use the August. We're going to go up to 4 of those. I think that's a very nice scenario right there. There's very little downside risk at all, and we can actually get unlimited upside potential on it. So let's go back to our trade tab. We're going to do 4 of the August 30s. Bump that up to 4 August 30s. And we're going to sell 1 of the July 25s. 1 of the July 25s. We got 267 and 62. 267 and 62. If we go ahead and put this order in, we have a total cost of $254 on the trade, including the commissions of $6. So let's go ahead and put that in. And we got filled right away. That's the thing I like about these kind of trades is we get filled right away. Of course, we are paying the market prices, but they're so favorable to us that we really don't have to worry too much. And there we are. Our maximum loss is going to be about $70, but since we're actually going to be probably closing it out before expiration, we just want to hold this through to earnings, and that's all we're really doing. We want to see the stock pop up, and if it goes up a few bucks, we're going to make some money, and that's all we're really looking to do. We're looking to make money on that news item, which is going to be the earnings announcements coming out on the 16th of July. So you can put these on just about any kind of stock that you want. I think they're very favorable, especially if you're somewhat bullish or bearish. Actually, it doesn't matter, actually. And if you wanted to, you could also play with a scenario in which you do just the opposite. You sell. You would buy an August put. Let's say you wanted to buy a couple of those, and you wanted to sell an in the money July put. I got to do it the other way. I want to make sure that I'm buying first, and I'm selling my put second. Now let's go ahead and analyze this. That's not a bad scenario either. Now you got a little more downside risk if it doesn't move, but now you've got unlimited potential on the downside and unlimited potential on the upside. So if you're looking for a truly huge move in eBay, you could do that. If we're doing the August 25 puts, we could go at August 22s. That's a little bit more risky. The 25s are a better choice. Go to 27.50. Oops. And we're risking $237 if it doesn't move. On the 25s, we're risking $150. It's a very favorable scenario either way, but you know what? I think what we got is pretty cool. I'm looking for an upside pop on eBay, so I'm just going to keep it at that. Limit my commissions. I still have very nice protection on the downside, so I think I'm good. But you can do it with puts as well, just to show you that it can be done either with calls or with puts. Like I said, I did it on, let's see, it was the XLF that I did with puts that also worked out very, very favorably here. I hit, it can go down. It doesn't cost me very much money. If it goes up, I make money. If it goes down, I make money. Very, very favorable kinds of trades that you can put on. And you can put these on all day long. They're very inexpensive. Here's the Verizon trade. Very inexpensive to put these on. And you have a lot of upside and downside protection either way. But it's a very, very favorable way to trade. You're not going to find this kind of information anywhere else. Really, this is very, very insider stuff. I hate to say that, but it really is true, because you could read all kinds of books and they're never going to demonstrate exactly how to make these kind of trades in these kinds of favorable conditions. And the only caveat is to use these on stocks that you think are really going to move. In other words, you don't want this thing just to sit there so that you lose, $40. $40 is not a lot, but still, if the price does not move at this point, I'm going to lose $42. And I don't like losing money at all. Believe me, I'm extremely risk adverse. I don't like losing money. So I want a stock that's really going to move. If I think I hear something in the news, or I know that earnings are going to be coming out relatively soon for a company that I think that has the potential to move dramatically, well, then I am actually going to put that trade on, because it's very low risk, very little money up front, but it has all kinds of upside and downside potential as you set it up. If you set it up with calls, you have unlimited upside potential. If you set it up with puts, you have unlimited profit potential on the downside if the stock trades down. Take a look through. There's many ways to find stocks in the news. You can use the Thinkorswim platform for the earning alerts. You can go online and look for earning alerts. You can look through, watch CNBC. Pay attention to the stocks that they're talking about that are potential takeover targets. They don't usually happen right away. You got to give them a few months, or maybe even maybe sometimes even happen in a few weeks. But generally, the stocks that everybody's talking about that are potential takeover targets are perfect for this kind of strategy. We only used, as I mentioned, we only used a few contracts for these. We have very little money into these types of trades. Margin requirements are very minimal. If you want to trade more contracts, you do increase your risk, so just keep that in mind. Hey guys, trade with confidence. As I mentioned, please send me any questions you have about this particular trade. This is a super dynamic way to trade up or down markets. You can make unlimited money, and you can just set these and forget these. Just make sure you have a calendar by your desk or some other way to track the timing of these events. In other words, if you're playing the earnings on eBay and you expect them on July 16th when they come out, you want to be able to put that on your calendar to keep an eye on this trade for July 16th after the market close and the next day. So that's it for today, guys. Hey, trade with confidence.